ดีค่ะ Welcome everyone to KPMG webinar on how management can foster resilience in a challenging economic environment. My name is Tongrat Pichitdet. I'm working in restructuring and value creation team at KPMG Deal Advisory in Thailand. And we are pleased to have you all in 1 hour session, which will give you an idea on how to prepare your business for a global economic downturn, such as the one affecting in Thai economy, which requires a combination of proactive financial management and strategic planning. Using financial performance index can be a valuable indicator to help you make informed decisions. So in this session, we are delighted to have 3 speakers join us for the discussion. First, we have Matt Crane, Head of Turnaround and Restructuring at KPMG in Thailand. He has over 10 years experience supporting clients understand and address complex challenges across strategy, operations, and cash flow management in both deals and restructuring situations. And next, we have Stefan, who has gained extensive insights in root causes of businesses in distress and how to address them in order to realize sustainable return again. And me, I have advised on several distressed transactions in Thailand for varieties of business and support in negotiating with stakeholders. Okay, so let's get started. Let me take a few minutes to go through agenda for this webinar. So the first session we will talk about global economic downturn and its main driver, which will affect on the global driver on the Thai economics. And then we will discuss on how the KPMG FPI can help identify the most impacted sectors. And the second last session we will give you an recommendations to foster resilience, and the last session we will have the Q&A sessions. So if you have any question, you can send us from the chat box. Okay, so I would hand over to Matt for the first session, which is global economic downturn and its main drivers.
Thank you, Tongrat, and good morning, everyone. Thanks so much for joining us this morning. So we wanted to start with the global macroeconomic situation. So we've got 2 key macroeconomic indicators on the slide. The first is GDP growth, and the second is inflation. So what we can see here is that after a post-COVID peak, particularly in GDP, we've now seen that return to more normalized levels with stable and reasonable growth for 2022. And 2023. However, what we can see is for the outlook, it's predicted to be relatively stable, and there is a large gap between the emerging economies and the advanced economies, where you'll see a very limited growth of less than 2% predicted through to 2027. And then if we look at inflation, I think we've all been feeling the pressures of inflation over the past 12 months or so in a post-COVID environment, with significant peaks across all economies in inflation in 2022. And that's remained relatively high in 2023 to date, and is still expected to maintain to still be high in 2024. So this is the high-level picture. I think one thing I would highlight here is whilst that GDP graph in particular is relatively flat from now through to 2027, I think one thing we've learned from the last few years with significant disruption is the only thing we can guarantee is that that graph will not look like that. There is bound to be other uncertainties, and this is where companies and management really need to prepare themselves for those shocks and uncertainties. And the other thing I'd say is it's the advanced economies where there is lower growth rates, and that really will have an impact on the whole economy, including the emerging markets that we operate here in Thailand. So if we move on to another angle, and that's about global trade volume. And again, something that impacts us here in Thailand. but also indicates how some of those macroeconomic global factors do affect everyone. And we've seen that with a number of examples that Stefan will take us through shortly. But again, if we look at global trade volume growth, again, we saw a significant post-COVID peak, and that's now returned or plummeted down in 2023 to only a 1.7% growth. However, we shouldn't be too negative. There is still a significant growth, and post-COVID, I think everyone's pleased to see that trade volume recover. And there is a little bit of growth into 2024 and 2025. So that global trade volume, despite a number of global challenges, which we'll talk about shortly, there is continued global trade volume expected. And then at the bottom of the chart, what we'll see here is the percentage of total global imports and exports driven by different economies. And what we can see there is that almost 50%, around 44% of that trade volume is driven by just 5 economies. Now, clearly, that's a simplistic view, and there are lots of other aspects impacting this. But I think it really just indicates that if there are large economies that are struggling for domestic reasons or reasons in neighboring countries, that is going to have an impact on all of us, whichever part of the world that we operate in. So just to close out on some of the key drivers, there's 4 areas that we've identified, which we will then talk in a little bit more detail about. So the first is the tightening of global financial conditions. So some of those macroeconomic factors I've talked about, but those are having knock-on effects in terms of interest rates and other monetary policies, both domestically and globally. We have geopolitical uncertainties. I think everyone is well aware of those, but those are significantly impacting the economy, again, globally and in our domestic markets. The third item is the economic leaders. And this links to the point I just made around the fact that 5 economies drive a lot of the global trade volume. Where some of those economic leaders are experiencing disruptions, those are going to have an impact on all of us. And the last item is the conservative investment outlook. And I think that's something we are seeing firsthand here in Thailand. And again, we'll talk about that later as well. So now I'll hand over to Stefan to talk through each one of these in a little bit more detail.
Yeah, thank you, Matt, for the overview of the global economy and the 4 key drivers of the current downturn. So let me first look into more details of these 4 key drivers. First, the tightening global financial conditions. So with the rising interest and the tightening global conditions, the risk of a financial crisis to come up increases. And the best example for this, everybody can see in the hiking interest rates that we are experiencing at the moment. So these interest rates, they have different impacts on the overall economy. First, worth noting is to say that the consumers, as the businesses as well, get more sensitive to the borrowing costs as the interest rates become more higher, and it's harder to finance investments or the current spending, personal spending, as well as business investments. Second, especially the banks are experiencing high pressure from the rising interest rates as their portfolios are devalued with the increased interest rates, and that leads to incurred losses, which put pressure on the lending capacity as they have various regulations to maintain. And the biggest risk for the developing economies are affected by currency depreciation, wider sovereign spreads, and a risk of distressed and servicing the debt, and that especially impacts as well the developing economies. Secondly, I want to look at the geopolitical uncertainties. There are several regions in the world that have experienced major rising conflicts or tensions. That is now interesting after several decades of the economies facing globalization and cooperation. Some regions now have conflicts coming up. Worth noting the first one, the Russian-Ukraine conflict, which started, or really the big outbreak was in February 2022, and it's now ongoing for more than 1.5 years. And one consider it's a local conflict, but as well, Ukraine and Russia are major providers of oil and gas supplies. So this has an overall effect on global energy prices and is the main driver of the inflation worldwide. As well, in Israel, just for a few weeks now, the outbreak of the conflict between the Hamas and Israel, it's in a region which is very important for oil gas production in the Gulf region. So there's a high risk that this conflict may spill over to neighboring countries when Muslim countries are supporting or joining in this conflict. If this risk continues, it may have a major impact on oil and gas prices and the global inflation. And third, the tensions between China and Taiwan are intensifying, and the tone has become more aggressive in recent months. And as well, one consider it's a local conflict, but it's important to know that Taiwan and China both are hubs for semiconductor production, and if this conflict intensifies, this may have a significant impact on global supply and the supply chains globally for semiconductors, which are a main input factor for many industries. So that's a big risk globally that cannot be ignored. Thirdly, as Matt already mentioned, we learned that only 5 companies are accountable for 50% of the global trade. And we also have seen that especially the leading and developed countries are more impacted by the economic downturn with significantly lower expected growth rates for GDP. So these major companies, economies, are big trading partners for all other economies. So they are a major supplier of raw material as well as business services. Secondly, they are also major consumers of commodities which are supplied by other countries. And thirdly, they are a big provider of financial support and developing aids around the globe. So one thing to mention here is an example as the Road and Belt initiative launched by China, and eventually also that has been slightly associated with the newly announced Thailand land bridge project, where there are rumors that China might support this project as well financially. So coming to China, that's quite a good example here, because China is experiencing internally several problems. As probably most people have heard, they're currently facing an unresolved real estate problem, which led also to a high amount of debt and distressed debt as well. They're also facing deflation, and as well they have a high youth unemployment rate at the moment. So with these internal factors, that has an impact externally to the global economy, with their weakening capacity to do foreign investments. And with this downturn in trades, there's less financial inflows into other companies from the weakened economy in China. And last but not least, they're also facing currency depreciation. So we can see like the impact from some major economies may be quite significant for other economies as well, and probably China is not the only factor here, as worldwide it can be seen for USA or Germany as well. And lastly, I want to talk about the conservative investment outlook. So both businesses as well as companies are anticipating the slowdown in the economy and the growth prospects, which leads basically to a downward circle. And good examples for this, on the one hand, for the industry side, it's the foreign direct investment indicator, which has dropped by 24% and is expected to persist on low levels. So this shows that companies refrain to do major foreign investments and don't want to or are not willing to spend as much money as they were before. And for the business side, the consumer confidence index is another good example, which is relatively volatile and still significantly below pre-pandemic levels. So that means that especially risk-averse people tend to increase their saving rates to be prepared for the risk of, for example, unemployment, and to be prepared. So all this together intensifies the pressure on the overall global economic outlook. So having had a look at the 4 key drivers into more detail, I now want to hand back to Tong, who will show how these drivers are affecting Thailand specifically.
Thank you, Stefan. And the global impact can have significant effect to the Thai economy, which can be both positive and negative way, which I will talk about some key impact which the global economic environment can impact in Thai economy. Firstly, about the financial conditions. The BOT, Bank of Thailand, has kept its policy interest rate at historically low level at 0.5% during COVID pandemic in 2020 and 2021. Regard to the future inflation, Bank of Thailand tend to increase the policy interest rate, which will put pressure onto first, stricter credit standards, which bank and financial institutions are more cautious about lending money. And the second, raise risks of debt distress from higher borrowing costs. And lastly, slowdown in household consumption and business investment. And also, the volatile current market, like Thai baht, is indeed influenced by various global financial policy, and the United States monetary policy also play a significant role in shaping our Thai currency value. The fluctuating U.S. oil price and interest rate can also indeed lead to frequent change in the U.S. dollar to Thai baht exchange rate, which can have several significant impacts on the Thai economy, such as risk, uncertainty for business and consumer spending, which uncertainty can lead to delay the investment decision and a cautious approach to expansion. Risks of import inflation and rise in cost of debt servicing. A depreciating Thai baht leads to higher import costs, which a decrease in export competitiveness can also negatively impact for Thailand trade balance, potentially leading to Thai deficits as the country export less and import more. Secondly, the geopolitical uncertainties also have a negative impact on Thai growth prospects, as they can create instabilities and uncertainty from various drivers. The tightening financial conditions and recession risks in the U.S. may be a risk to Thai export, Also, Russia and Ukraine economic ongoing tension could impact Thailand exports, inflation and GDP growth from higher energy costs and increase in commodity price, as well as conflict between Israel and Hamas. Moreover, China real estate crisis and policy shift will continue to impact Thai. It's reduced Chinese consumer spending and business prospects, which Thailand is a major tourist destination and FDI partner for China. And also, the conflict between Taiwan and China geopolitical tensions will continue to disrupt the semiconductor supply chain, which might impact manufacturing business in Thailand. So this ongoing global conservative spending and investment can lead to worsening of increase in existing non-performing loan and worsening of consumer spending in Thailand. So based on the major drivers that, as we mentioned earlier, Thai economy outlook is anticipated to grow slower than expected. However, the expectation that Thai economy will perform similar or better than other economies despite anticipated hurdles to economic growth reflects a positive outlook and suggests that Thai may be well positioned to overcome its challenge. Like several factors can contribute to this relative resilience and performance, such as Thai still leads Southeast Asia tourist arrival. In first quarter 2023, Thailand can drive the GDP growth from tourist sector. And secondly, unemployment rate falling close to pre-pandemic level. Lastly, the increasing business investment, which large corporations continue to invest. Despite domestic hurdles, Chinese investments are still significant. Invest in Thai and mitigate risks among Chinese real estate debt crisis in China. Okay, and the next session I will hand over back to Stefan.
Thank you, Tom, for these quite interesting insights in the Thai economy. And I'm happy now to introduce to you the KPMG Financial Performance Index. We call it FPI. The FPI is an indicator of financial performance taking into account different data, especially company financial data that is publicly available, but also market data and data on the market capitalization and stock prices and stock price movements. So what we have available is a quite extensive database. For Thailand, we are looking at almost 800 listed companies that are listed on the Thai Stock Exchange. These 800 companies are covering 19 sectors in Thailand, and these 19 sectors can be further divided into 53 sub-sectors. And from a timing perspective, we are looking back at 26 quarters for which we have the FPI index calculated. As information, the FPI index, that's an indicator for the risk of default, meaning the closer it is to zero, the higher the risk of default, and the more closer it gets to 100, the better the financial condition of a company and the economy is. So having that the FPI, if you're looking over time, was quite a good predictor or like reflecting major trends in a quite good way. So here, looking at the FPI development over the past few years, starting in the second quarter 2019, we can see the very big impact that the COVID-19 outbreak had in the first quarter of 2020. So we are both looking at Thailand and the global development, and the impact is quite significantly both in Thailand and globally. And then second and third, we can see the impact for the second wave and the third wave for COVID-19 in Thailand. And what we see over time, that Thailand was less impacted by the slowdown of the economy than other countries, especially looking at the global level. And we also can see in the third quarter 22, there's a quite an increase for the FPI in Thailand, and that is directly linked to the ease of entry restrictions. As we all know, Thailand is quite a big tourist destination, and after opening up for all the travelers, the prospects for the Thai economy were rising quite significantly. So we don't only have to look at the economy in total, but we also can identify which are the best performing sectors, and not surprisingly, we can see the travel and hospitality as one of the performing or best performing sectors in Thailand again after recovery from COVID, but as well to mention the healthcare sector, which is quite big in Thailand, and packaging products. However, the bottom sectors aligned to financial services, agriculture, and technology and communications. If we want to have a more closer look at different industries and sectors, we show here a display for the biggest the biggest sectors in Thailand. And from the performing perspective, energy is quite performing well and make a quite big portion of the listed companies in Thailand. Healthcare is, as mentioned before, quite a well-performing sector and significant for Thailand as well. And travel and hospitality can be seen in this picture on the well-performing side as well. However, on the other side, raw materials, business services, and financial services, quite big sectors in Thailand, and as well the infrastructure and real estate and utilities. However, we have just a quite static view on the economy here and the analysis. I want to show you a live demo of this tool and how we can play around with this data. So let me just go into our database, which you can see we can play around with the data. And looking at the first picture here, we see the KPI index globally, and we can see it based on different levels, and we can look at different industries and different countries. So I'm selecting Thailand here, what is the most interesting for us. And we can see the same development as we have seen in the previous slide I was sharing over time. And we can see there's a split for the different sectors and subsectors. And the major downturn, the brown and the black, these reflect the coal industry as well as the independent energy producing companies, which is like it can be understood in a way that with the COVID-19 outbreak and the lockdown effects, production was ceased in many factories, so the demand for electricity and coal dropped quite significantly and was ramping up again after the lockdowns were loosened. We can also compare different regions. So looking globally, we can select different region and compare the FPI amongst other countries. So looking at Asia, we can see that Thailand at the moment is quite in the average compared to other companies. It's not the best performing economy, but also not in the low performing. So giving quite a confidence for Thailand. So, and looking at this, it can be quite interesting for leaders to see how they can diversify in their supply chain or in their consumers. If it's worth to expand to certain markets, or if it's worth to explore a different sourcing if their main geopolitical footprint is showing that these economies are facing some challenges. And then we can see the breakdown of different markets as well and the development over time. So we can play around with the data. Here we are looking at the global data, but we can go more into details and, for example, select Asia again and see which are the best performing and low performing industries in Asia. Generally, it's quite surprising that we have seen before healthcare in Asia is quite underperforming, and that's surprising because Thailand basically is showing that healthcare is quite well performing. And we can see this again if we're going more into detail and selecting Thailand here. Where we can see the same picture showing which are the best performing companies. We can select the quarter, the times where we are looking at. And also as an indicator, we are looking at the same time frame for the development since fourth quarter 2021. And we can see a quite similar picture as before. And as I said, the infrastructure and real estate is one of the lower performing sectors. And I think as it was aware before, there were some defaults for companies in this market, which is quite a good predictor to identify which sectors may be facing higher risks than other sectors. So if you're interested in these analyses, our website provides a quite comprehensive summary of this data. You can play around and see it. It's easy to access. And I also recommend you to have a look at our just a few weeks back published newsletter on especially the Thai market and main drivers we can analyze for the Thai economies. And if you're interested in even more details, please feel free to reach out to us. We can give a more detailed demonstration of this tool and address specific questions you may have or be interested in. So having talked about the FPI and how to identify specific sectors that may be at risk, I want now hand back to Matt, as you're probably all keen and interested in our recommendations, how you can foster resilience in your businesses.
Okay, great. Thank you, Stefan. So hopefully that was interesting. So I think we've covered a lot of the global economy, the impact on Thailand, and now hopefully that was of interest to see our KPMG FPI tool, where you can start to drill into particular sectors and trends in Thailand and globally. But now to maybe the core topic of today's webinar is some of our recommendations to companies on how you can foster resilience given all of those challenges that we've just highlighted. So the first one I want to talk about is cash flow. Cash is king is the old saying. There's another saying which I particularly like, which is that revenue is vanity, profit is sanity, and cash is reality. And I think that remains ever true, and particularly here in Thailand, where we have many companies very much focused on their revenue growth, sometimes profit, but often not so much cash flow. So we would strongly recommend any company should have a real handle and visibility on their cash flow and develop a short-term liquidity forecast. So why is that important? Hopefully it's obvious to many of the audience here, but a couple of key things to highlight. How much cash do we currently have? So where is that cash coming from, and how much do we have today? Again, I would add that maybe 9 times out of 10 on some of the restructuring turnaround projects we do, a company doesn't actually know or have a real handle on what that cash flow looks like. The second key question we have on this page is how long does that cash flow last? Again, that's the key one that we often see companies we work with. They don't have a handle on that and are not sure when they might run out of cash or what provisions they might need to make sure that they've got enough cash flow. You can also look at use the cash flow forecast to identify if there's any mitigating actions you might want to take, whether that's working capital adjustments or maybe to reduce your cost base. So again, why it's really important. And I think the other thing I would add is, this is a day-to-day activity for any management company. Someone should be looking at this cash flow, understanding what's happening. I have worked with some companies, particularly retailers, actually in the UK. Some of those CFOs, they had a daily cash flow. So they wanted to forecast every single day, how much cash are we going to get in the till, how much do we need to pay out, so that they could see if they were having any upcoming issues. And then why is that also important? Because you can then manage any fluctuations in your forecast versus actuals and see whether there'll be some problems up ahead. So I think hopefully quite clear why cash and cash flow is important. So if we go to the next slide, I'll share some of our recommendations about how we would recommend companies develop a short-term liquidity forecast. So many CFOs or financial teams will be familiar with an integrated financial model, P&L, balance sheet, cash flow. But actually what we would recommend is a more focused direct cash flow. Yes, you should have a longer-term financial outlook and model, but I think what we're talking about here, and in terms of fostering resilience for some of these economic downturns, we would recommend a short-term cash flow forecast that uses a direct method. So what does that look like? The time horizon, we would typically say a 13-week. This is very broad industry standard of a 13-week cash flow that allows you a 3-month runway and is seen as a good level of time to manage your cash flow, and also a reasonable time frame in which 3 months ahead you should have a handle on what payments you might be expecting to make, what sources of cash you'd be expecting to receive. The methodology, as I've already mentioned, should be direct. And let me talk a little bit about this diagram you'll see at the top of this page. The first one is accounting data. So we would typically use the balance sheet, so accounts payable and accounts receivable, and maybe any purchase orders if those are captured. So you can use that as a static point of time to say, okay, how much money will I receive from my customers? How much do I need to pay to the existing commitments I've made? And then on the top right-hand side, we have the forecast data, which is a lot more challenging in today's environment than it maybe has been ever before. But how are you forecasting how much you're going to sell, whether you expect to receive the money at a particular point in time, or there might be a delay. So again, we would typically look at historical revenue figures, historical P&L figures to try and forecast those. And then we have at the bottom continuing obligations. Sometimes these things are missed, but they may not be obvious on your accounting data or your P&L. Maybe a rental payment that you pay once a quarter or once a year, but in your P&L, that is spread out over every month. So you need to capture those key payments, including interest, salaries, and any debt repayments. So that's how we would generally pull a short-term cash flow together. And then accuracy. Again, one thing I always like to say is that the only thing you can tell about a forecast is that it's not going to be accurate. but you should have a reasonable level of accuracy for the first 1 to 2 weeks, and then a relatively strong level of accuracy beyond that, but it will obviously deteriorate. And that leads to our last comment on the bottom right there. It's very important to have a regular update of your forecast versus your actual. We typically recommend this on a weekly basis. You can then identify where the gaps are and if you need to improve your forecasting methodology going forward. Okay, so a really critical point that hopefully is helpful for everyone to take away. The next thing we want to talk about is working capital. Again, it's a topic I hear spoken about a lot in and around Thailand and with our clients, but I think there are different interpretations. Often you'll hear that a company needs extra money for working capital, but actually when you dig deeper, maybe it's really needed to pay salaries or fix costs or even make a capital investment, which actually is not working capital. So this is how we look at it at KPMG. We have these 3 cycles: purchase to pay, order to cash, and forecast to deliver. So in accounting terminology, purchase to pay would be your accounts payable, order to cash your accounts receivable, and forecast to deliver your inventory. However, the key point here is that those accounting terminologies I've just used are point-in-time balance sheet. What you'll see on the page here is actually the working capital management cycles, which derive that ending point-in-time balance. But it is all of these different aspects which need to be looked at and understood in order to really optimize your working capital. So, for example, on purchase to pay, that's not only about your payment terms with suppliers, which is often where people will focus. That starts with your procurement strategy. Who are you buying from? When are you buying? Goes all the way through to your supplier selection. How are you receiving invoices from your suppliers? And then when have you agreed to pay them? So there's a number of specific operations processes within that which will impact your working capital. And the same goes for order to cash. Starting from your sales team, they need to understand the impact of working capital and cash flow on what they're negotiating in terms of terms or payment methods, all the way through to actually collecting that money from your customers. And lastly, forecast to deliver, often the most complex one in terms of inventory management. Again, that starts all the way at the beginning when you're talking about the number of products you're selling. So if you're selling 2,000 different products or 50 different products, that's going to have a very different impact on how you can manage your inventory and manage your working capital. All the way through to manufacturing. If you're a manufacturing business, how are you scheduling? What are your minimum order quantities? How are you deciding what to produce when? All of that will impact the cash flow and working capital that you have on hand. So hopefully that's a good introduction into how we look at working capital and what we would recommend. If I give some specific tips around working capital, there's 4 that I've just highlighted here. The first is about invoicing and collections. Again, invoicing is something that's often overlooked. But if you take 2 weeks or a month to raise an invoice, that's 2 weeks or a month's worth of cash flow that your customer won't pay you until later. So really focus on that invoicing. Make sure you're getting those invoices out as soon as possible, accurately, and getting those into your customer's inbox or in their hands if you need. And then when invoices become overdue, we should really be following up on those immediately and chasing up on those collections. And that's something I would specifically highlight as we are seeing some global economic stress, and we are seeing that in Thailand. We do expect some customers or some companies to be experiencing challenges, so you should look out for early warning signs in your own customers, and you should address those proactively. Second is forecast inventory requirements. Really challenging to effectively forecast your stock requirement. And again, one of those things that you are rarely going to get 100% accurate, but we do recommend going into detail into your forecasts for inventory and making sure you have the right inventory in the right place at the right time and you're not buying too much stock. Third aspect is payments to your suppliers. We do recommend full transparency with your suppliers. Often people use this as a lever, a tactic to just not pay suppliers if you need extra working capital or cash flow. But we would recommend a structured, formal approach. But do make sure you're not paying them every day. That's not industry practice anymore. It's quite common to have a weekly or even in extreme cases a monthly payment run. As long as that's communicated effectively, then that can help you more effectively manage your working capital. And then the last point is around data and analytics. Again, a bit of a buzzword. I know everyone talks about data and analytics. But if you think about those cycles that we just talked about, there's a lot of data in those cycles. The number of customers, number of products, number of invoices. And what we do at KPMG, we have data analytics tools specifically for working capital, where we analyze invoice level data for accounts receivable, invoice level data for accounts payable, and SKU level data for inventory. And this can bring you some really valuable insights into what is driving your working capital. So please do use that data. It is available for most companies, and you can do some very simple but impactful analysis. Okay, and then the last recommendation from me is to undertake a rapid business assessment. And I apologize, I know that's a little bit maybe consulting terminology, but we do recommend that businesses critically assess their own operations and from all of these aspects. So it could be a market competition aspect. Often we find when we're brought into situations where there is distress, it is market driven. So make sure you understand your market, what's happening, and you're ready for those changes. And if you're losing market share, you know that at least, and you know how to try and combat that. Operations as well. What is your production? What are your processes? Are there issues on the people side? That needs to be looked at as well to see if there's any weaknesses that you need to prepare for. Financials, obviously, without doubt. We've talked about cash flow. But again, looking at your historical margins, historical working capital metrics, identifying signs of distress or deterioration, a really key thing to do. And then lastly, tax and legal. Often there are tax legal issues that arise. That can be an indicator of potential distress as well. And you don't only have to do this on your business. Often we get brought in because maybe a key supplier or a key customer is of concern. So you can also support your customers, suppliers in asking them to undertake one of these exercises as well. Okay, so to wrap up, 3 recommendations. Make sure you have a robust liquidity forecast. I would say if you're only going to do one thing, please make sure it's that. Secondly, optimize your working capital. You may find that there's extra cash flow available to you internally. And lastly, look at your own business, undertake a very rapid assessment, and see where you need to strengthen. Okay, so I think I'll hand over back to Tom to facilitate some Q&A.
Yeah, thank you, Matt and Stefan, for sharing the business outlook and tips and recommendations for every business to use and apply to your situation. So let's move on to the last session, which is our Q&A session. So we have the open chat box. So if you have any question, please feel free to send us through the chat box. Okay, so we got some questions from audience, and let me ask maybe Matt first. For the business perspective, like how long will it take for the business for the rapid assessment of the business?
Okay, yeah, thanks for the question. So often in these situations, time is of the essence. So quite often we get brought in and the company needs to know what's happening very quickly. So actually for these rapid assessments, we have been known to do them in as short as 1 to 2 weeks. That's typically what we do. You analyze the cash flow, you gather the historical financial information, you understand what debt commitments the company might have, You maybe do a quick assessment of the market outlook for that company. So yeah, it can take, can be as short as 1 to 2 weeks. I would say if a company is going to do that themselves, it may take a little bit longer, 4 to 6 weeks. But I think the most important thing is be proactive and do that early. And then if it takes you 1 or 2 weeks or 4 to 6 weeks, at least you have a pretty clear understanding of where the weaknesses are potentially in the business and how you need to strengthen those against some of these economic headwinds.
Okay. So it should link to the next question on the FPI index. So like when Stefan showed the FPI index and like you look at different indicators, and when you say like the healthcare sector, it's the best one. It's like why is healthcare the top performing sector? Like how you look at it, how you use the number and analyze, like to give an idea, like initial idea of how to work on the number.
Okay, thank you. So as I said, the FPI is taking into account all the financial data that is publicly available, as well as market data that we can assess. So we're using Capital IQ as the database to calculate different ratios all together. And for the healthcare sector, specifically in Thailand, what we have identified, there are several trends impacting the healthcare sector. So one of them is the overall aging population, which drives the demand for healthcare products, which is obviously like as well as global driver. And for Thailand specifically, there are two other trends. One is the government support, the financial support for this industry is continued to increase, which has a quite good and positive impact on this industry specifically. And last but not least, one other key driver that we have identified for Thailand is after the COVID pandemic, the tourist industry is increasing again, and not only the leisure tourism, but also the medical tourism into Thailand. So Thailand is quite famous and popular for tourists coming in, not tourists, foreigners coming in to experience and take benefit from the developed Thai healthcare system and hospitals, which are attractive for foreigners as well. So these are the main drivers we could identify, and that's the reason why the Thai healthcare sector is performing quite well, and also experienced the increase over time in the FPI index.
Okay. Let's move on to the next question. What would you recommend about the system, team, and management under dynamic environments with higher demand from top executive? For example, like system development or people seeking put the right people.
Okay, yeah, a great question actually. So a couple of things I'd recommend in these kind of situations. As a management team, yes, you've got to be agile. You've got to be flexible, dynamic. So maybe as a company, you have a set monthly board meeting or a set monthly meeting. I think in these kind of situations, you may need to be a bit more dynamic, agile. You might need to have more frequent meetings, maybe more focused meetings. That's one thing I'd recommend. The second is to be decisive. Often in these situations, there are decisions need to be made, and without a lot of time. And I know sometimes management want to do more analysis, more understanding, and that is needed, don't get me wrong. But I think as a leadership executive team, there's a need to make decisions maybe quicker than you may want to in normal situations, and have to apply maybe an 80-20 rule in that, okay, I have 80% of the information maybe I would like to have, but it's enough for me to make a decision today in order to move forward. And then the last thing, you mentioned people in the question. This is absolutely critical. I would say any business, you've got to have the right people around you. And often when we come in and we do turnaround restructuring engagements, we often support those companies to bring in other management teams. We often see in Thailand things are managed by maybe one or two very strong individuals, but they can't do everything. So I would make sure you have the right people around you and do recruit. It's difficult to find the right people sometimes, but that is really critical, and that's how you're going to progress and achieve resilience in this market.
Okay, all right. Thank you, Matt. For the next section, as we mentioned earlier about the economics, that they have a lot of uncertainty about the political interest rate, with the higher cost of debt, which will affect bond market. And do you have any expectation for more distressed cases will happen in the future?
Okay, yeah, thanks again for that question. It's something we're talking a lot about with our clients. Many people are asking us. And yeah, look, I think it's well known in the public that the bond market there is some instability in Thailand at the moment. And I think one thing about Thailand, the liquidity has been very accessible for many years in Thailand, and that's a great thing. It's really driven the growth in the economy. However, we are starting to see those signs of distress impacting the bond market, and there is a little bit of a knock-on effect. We do expect tightening in the bond market. We also are aware that the government will be issuing government bonds, so a lot of that liquidity will potentially be transferred out of the corporate bond market and into the government bond market. So many corporates in Thailand have successfully raised bonds, and we do expect that as some of those come to mature, those corporates may need to seek other sources of funds in order to repay. So yes, I think is the short answer. We do expect to see more signs of distress, and that's why we would recommend companies to foster resilience.
Okay, I see. So for the conscious of time, and may I go through the last question. This question for Stefan. How does KPMG consolidate 798 headquarters in Thailand for the FPI data index? And onto what basics are these selected?
Okay, thank you for this question. And as I said in the previous question on the FPI, we are using the database that is available on Capital IQ, so we extract the data there, and that basically links to all the companies that are listed in Thailand. So there are roughly 800 or the 798 or more than this number listed companies in Thailand on the SET. However, financial data is not always published on time, and some of the data is a little bit difficult to analyze, and we cannot calculate all the ratios. So basically the number comes from the overall number of listed companies, and for those which have publicly available data published into the Capital IQ database, and based on the consistency and availability of the data quality for these companies, so narrowing it down to this number of roughly 800. So yeah, we are forming a broad overview of the whole Thailand stock market, basically based on the availability of the data. That's how we come up with this 800 listed company or data points for Thailand economy. Thank you.
Okay, thank you, Stefan. And so this is the people from our KPMG restructuring group. So if you have any questions, you can contact one of these or you can call whoever you want to. Okay, for the last session, so like we come up to the end of the sessions. Like we hope this session will be informative and more aware of the impacts of the global economics. If you want any assistance, so we are pleased to help you. If you are, it would be appreciated if you can do a survey from this content. You can use this QR code to get. We would like to get you the feedback and further recommendation from you. And thank you for your kind attention. All right, and thank you, Stefan and Matt. ขอบคุณค่ะ
Thank you ขอบคุณครับ